Worked to shore up votes to get the bill across the finish line that would extend the country's borrowing limit. Not a lot of time left, as the Treasury Department estimates the country would run out of the ability to pay its bills in roughly a week, and America's credit rating at risk. That's the basis for our segment this morning with Ernie Burns from Burns Financial Planning. Good morning.
Good morning.
And Wealth Advisors. This is a big vote.
Yes, it is.
You know, stuff gets blown up sometimes and hyped. This is a big vote.
This is because, I mean, if they can't falter what they did in 2011. If they do that again, then you're looking at a definite pullback in the market of 5 to 10%. They have to vote on this today and pass it, or you're going to start seeing the market go in reverse.
So the market is down 100, the Dow is down 132 points right now. It was down a little more earlier. What's it saying this morning?
What's it saying right now is they're weighing on the vote, and also China reported weak economic earnings. So their employment rate's very high right now. They're not reporting a whole lot of it. We're finding out more and more about them. So the market's kind of weighing all this in right now.
You know, that's a very good point. You and I both learned something in the last couple of days, and that is that the Chinese unemployment rate among young people, young adults, is 20-ish%.
Yes, and that's amazing because it's a communist country, right? I thought everybody had jobs. They wanted everybody to work, and they didn't have enough people. So all of a sudden now this report comes out that unemployment's over 20%. That's a big surprise, and economic slowdown. So the market's going to pull back a little bit from that. But right now, the debt ceiling is the big question.
You know, we were talking about this also. Is if you're somebody who's looking at your 401k, or maybe somebody who's older in age looking at you know, your retirement money, you might look at this. If this were to drop another 5–10%, all of a sudden you're flirting with 30,000 instead of 32 or so. It's almost like a lost decade for people.
Well, people don't think about it, but a lot. But we're not recovered from last year yet, really. You know, and look at the 90s. 90s, from 90 to 2000, you had 18% average growth. From 2000 to 2010, you had 2 stock market crashes. The S&P did half of 1%. So we went like a roller coaster. Then 2010 to 2020. We had a 15% average growth rate. So now we're in that roller coaster ride. Are we going back down again, or are we actually going to have another ride up? So it's questionable. That analogy is scary for the next decade. We've already had 2 crashes in the last 3 years.
And I don't want to, you know, you sometimes are fairly bullish about the direction of the market. I don't want to paint a picture that's inaccurate here, but all of this in the context of the Fed and the question about, is it done or is it not with raising interest rates?
Yeah, and the market has baked in right now another 0.25% rise. That's another thing that's been happening with the market over the last 2 weeks. Prior to that, the market pretty much baked in that they would not raise interest rates again. They would pause. Now, we personally believe they should pause because they've already raised it faster than any administration has in the past. So the Feds have been very aggressive. However, the market's baked, I think this morning was 67% chance they raise it 0.25%.
Which kind of goes counter to what was thought as the conventional wisdom only a few weeks ago.
There you go. And how much this debt is really adding up? You know, 6 to 8% they're charging on interest, credit loans, and cars and housing, mortgages. People haven't seen these interest rates for a couple of decades. So this is really a lagging indicator.
And unfortunately we're out of time, but we'll have to do that as a segment sometime. It's, you know, people my age, your age, remember, you know, when interest rates went from 6, 7, 8% up to, you know, 18% for credit cards. Younger people, and I'm talking about, you know, grown-ups in their 30s, almost 40 years old, don't remember those days and have never really dealt with that as a financial reality.
The parents had 12 and 15% mortgages. They've never seen it.
Well, hopefully we won't. Ernie Burns, appreciate your time as always.